Did you know the top 500 asset managers now control a record $131 trillion on any given day? That's what they T, which is an insane number. All told, about $558 billion moves to the stock market every single day in the U.S. Every day. That's how much money flows to the stock market.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. Back at the desk, been away for a week, 2 great conferences back to back. Tons to talk about. Fed spoke at Jackson Hole last week, and it really solidified why this meeting with central bankers all over the world continues to produce news. You would think it wouldn't, just a bunch of people hanging out and at a beautiful place put on by the Kansas City Fed. Of course, they're the host for over 40 years. But then they make news. They make announcements. It's basically like a meeting within a meeting. And it always seems to be noteworthy, at least the last couple of years. But before I get into all that, we talk a lot about certainty versus uncertainty, the flow of money, the velocity of money. And nobody, handles the velocity of money and the flow of money and the supply of money more than the Fed, which is why it's so important to watch what they talk about. But you know what? The stock market is a big source of money and flow of money. And I know that we've got, I am not responsible for your losses, only your profits. I am not a financial advisor, but we have a big earnings report to end Q2 earnings season this week. So there's just 22 companies left in the S&P 500, and they're done this week. And then we go into Labor Day. Speaking of labor, kind of an important thing. It seems to be the only focus of the Fed right now. But Nvidia is the power engine of all the software and chips design for artificial intelligence, which of course is changing the landscape of labor. And so I saw a pretty funny article over the weekend. It said, Monday we'll be thinking about Nvidia earnings. Tuesday we'll be losing sleep over Nvidia earnings. Wednesday, after market close, is Nvidia earnings. Thursday, we will be reviewing Nvidia earnings. And then on Friday, we will be guessing the next set of Nvidia earnings. So in case you don't know, it's a semiconductor chip company. It's massive. If anyone is invested in the stock, you are absolutely crushing it. But it is priced to perfection. So any slip up in the revenue estimate or sales estimates or forward guidance, most could see a sell off on that stock. There's an old adage in the stock market that say buy on the rumor, sell on the news. So even if it's a perfect report, people could just sell because they're so scared. Look what happened in the yen carry trade, the first Monday of August, when that blew up the stock market. Now, it was like institutional traders are looking for a reason to be scared if growth doesn't come in and our economy doesn't grow and we don't meet earnings and growth estimates and expectations of analysts during this earnings season. And so we had a growth scare that day. And so I think it's important for, for us to kind of see and react, with the market that could be climbing a wall of worry like it always does. But I do think some of this growth scare is justified. Look at the 10-year Treasury. It keeps coming down to around 380. Look at the Fed starting to cut, okay? Look at the yield curve, the 10-year and Treasury and 2-year yield. Is it uninverting? Because that could be the biggest news to come out. We've seen the SOM rule. The unemployment has risen very quickly in a very short amount of time. But, we've talked about this 10-year, 2-year, yield curve inversion that always precedes a recession. But the recession doesn't actually happen or start until after that yield curve uninverts. We got really close. I haven't looked at the numbers today, but we were within, 10 basis points. And that thing was as high as, 1 point or more, 2, 3. Gosh, I can't remember at this point. So it's the longest, most anticipated recession ever. We saw 818,000 jobs just poof disappear. And it does matter. And it is unexpected. And I can't believe there's anyone even defending, how that happened. Every single jobs report, every first Friday of every month, the Bureau of Labor Statistics puts out a jobs report, and the market waits with bated breath. What news is going on with labor? The tri-mandate that the Fed has, one of those things is full employment. Do we have full employment? And then the stock market rips one way or the other, and bonds sell off, or climb. It's a meaningful number that comes out. And for all of it to be rendered meaningless by such a wide margin, literally one of the widest margins ever, is meaningful. And I think if you look at the U6 unemployment rate, which no one is talking about, that is the underemployed. Okay, not just people that do. So the U3 is the main report that comes out the first Friday of every month. When you see that 4.3%, but the U6 is basically underemployed. It kind of catches a wider set of data and encapsulates our entire labor force. That rate as of July is 8.2%. And we haven't seen those numbers in some time. You can go on and you can Google it. I went to a place called Y Charts. We haven't seen that number since, 21. So, coming out of the pandemic when it was as high as, 18.3%. So, ¿qué pasa, amigo? Yeah. Our cleaning crew here. Anyway, that number is going up. And so you have the unemployment rate going up. We have 818,000 jobs disappear. We have another jobs report coming out before the next Fed meeting. That's going to be a big deal. Trust me, that is huge. That's next week. We have an inflation report this week, the personal consumption expenditure, which the Fed takeaway from Jackson Hole is that Fed is whipped. I mean, obviously, if they said they're going to start cutting, then they feel like inflation is tame, and all they talked about was labor. So are we back to a single mandate where they're singularly focused on labor? Remember, for like 2 or 3 years, they were singularly focused on inflation when they let it get away before they said it was transitory and not a big deal. Are they now behind the curve on labor, and that's why they're cutting, and that's why they're talking about cutting, and they're talking about it? So let's get into it. By the way, the flow of money, I just want to put a button on this earnings report in the stock market. This is crazy. Did you know the top 500 asset managers now control a record $131 trillion on any given day? That's what they T, which is an insane number. All told, about $558 billion moves to the stock market every single day in the U.S. Every day. That's how much money flows to the stock market. 90% of it is, run by these institutional traders, and 80% of that's done by the computers, algorithms, high-frequency trading. That's why you saw such a steep sell-off so fast when that yen carry trade blew up. So if we have another growth scare number or reading or something that comes out, or Nvidia earnings that misses, who knows? You could see the market sell off. I still think long-term it's great to be invested in the market, and trying to call a bottom is hard. I try and call it all the time. I try and call tops. I read a lot of analysis because I like to trade options and try and make supplemental income. Plus, it's like gambling. But anyway, a lot of money flowing around. Okay, the time has come for policy to adjust. That is what the Fed started with. That is what Chair Powell said at Jackson Hole at the meeting. The direction of travel is clear, and the timing of and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. Now, the market has priced in many cuts, and they've priced in that balance of risk to really only be about labor. And so inflation, is it solved? Is it whipped? We know that housing is going to rip and go up again. We know that home prices are going to go up when interest rates come down because there aren't enough homes for sale. Yes, the numbers have come down recently on these inflation reports, the PCE and CPI. And there are some lag effects, of rents and housing coming back in. But I do think some of the timing, okay, now I'm going to take the other side of this coin you've never heard me say. They're starting the cuts because this is maybe as good as it's going to get on the inflation number. It's not actually going to get to 2 because of housing. And you know what? The Fed can't build more houses. Can't do it. Can't do it. They cannot build more supply. This is tough. It's having a negative impact on the wealth effect. Housing has been a very tough go the last, let's call it 2 years. So lower rates helps with home affordability. And so hopefully there's some innovation or some builders are going to get out there and keep trying to find ways to build more affordable housing. And so, knock on wood, fingers crossed there. But I think the Fed knows they can't do much more with the housing component. They've done everything they could with all the other components in that. So the cooling in the labor market conditions is unmistakable. Quote, it seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. Remember we talk about the wage price spiral? Wages aren't going up. Part of this labor data is that, we are normalizing our labor force. We are getting back to pre-COVID levels of our labor force. But the reason the 4.3% unemployment rate came out on the last report was because the labor force is growing, or at least it's more visible in these reports, even though 818,000 jobs disappeared. But if you look at, there are more people coming in and reporting and making claims for unemployment that we watch every week on Thursdays for, jobless claims. And so if the labor force is growing and productivity is up and participation is at 80.2% of our labor force, which is a good number, that's as soft as it's going to get. It is not going to get better. So I think the Fed knows that, and that's why they're almost singularly focused on labor now, and they are starting the rate cuts to start increasing the supply of money. Now, for my conspiracy theorists out there, although I don't think this is a conspiracy, the dollar weakens when the Fed cuts. That's actually good for our exports. That's good for our multinational companies. Think Tesla and Apple that sell their products in China and other places. And so a less strong dollar, a weakening dollar across the globe is actually good for our businesses selling and exporting out. We're the biggest natural gas exporter in the world. We have huge oil reserves. We're a huge refiner. So these are all good things for those parts of the economy. But the conspiracy theory, and this is not like, this is kind of factual. We have these old debts that come due, these treasuries, these bond auctions that are going on this week. I think 10s, 2s, 5s, and 7s. When these bonds are being paid off, or older ones are coming mature and they're having to be refunded, a lot more cheaper, weaker dollars is good for us trying to pay back that interest. And so it's good for us. It may not be good for other countries that don't hold as many dollar supply, and then that strength of their dollar is weakening, but they're paying us back, the foreign owners of U.S. treasuries and bonds and bills. They're paying us back with weaker dollars. And so that is part of the Fed's grand design. And so these are things to think about. I won't get into that anymore. Let's keep going with labor. We do not seek or welcome further cooling in labor market conditions. It's cooling. We will do everything we can to support a strong labor market as we make further progress towards price stability. So that's it. It's about labor. I think they gave up on inflation. They're obviously starting to cut rates. Hasn't happened yet. It supposedly September 18th. Who knows? Maybe all the economic data between then and now is so strong that they don't cut labor. By the way, the Fed meeting minutes from the July meeting came out. Remember, that's the one with no dot plot. And basically they were saying, there were people who were ready to cut right then. And then most of the members are saying, you know what, we want to see just a little bit more data. Maybe we'll think about it for the next meeting. Of course, had to have Jackson Hole talk to the other, row bankers from around the world. And then they got their September 18th dot plot. So they have the cover. So now everyone's covered. Everyone can look like they're all on the same page. No one's an outlier. And they go back to their board and their governors and whatever and look like jerks. Anyway, lots going on this week. We got JOLTS data coming out next week. That's a big number, obviously. The nonfarm payrolls coming out. We'll see that. PCE. And before I get into politics, let me just give you one more little growth scare comment here. Elliot Eisenberg, the bow tie economist, he's awesome. He just put this out. Gross GDP. Remember, our economy is 70% consumer spending, and so gross domestic product is a big deal. Do we have growth or not? The latest Q3 GDP, okay, estimate from Atlanta Fed is 2%. That's even, okay, down from 2.9% a week ago. Similarly, the New York Fed sees 1.8%, down from 2.2, and the Fed sees 1.3, down from 1.6. Are we in a recession? I don't know. You know what? I'll get into the politics stuff later. But 4 donors donated $400 million to this campaign. I thought that was crazy. And just 50 political donors combined for $1.5 billion in contributions. Man, there's a lot of money and power at stake here. Have a great week. We'll get back to you soon. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.